Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the subscribers and the comments, the stock recommendations. I really appreciate it. I especially like all the comments inside the debate over growth forecasts, valuation multiples within companies. Great stuff. Thank you very much for all the comments. I greatly appreciate it. This channel is dedicated to the rational investor, that investor that's seeking cash flow. We are not interested in dotted lines, fancy charts. We buy cash money in this channel, and we look for every business to generate that money, and we value it based on the cash flow it generates. We look at all investments with 5 key attributes. That would be top line revenue growth, earnings growth on an EBITDA basis, enterprise level EBITDA, strong free cash flow, a solid balance sheet being less than 3 times debt to EBITDA, and a well-priced stock, well-priced being enterprise value to EBITDA as our value metric. And the value metric is very important. Please go back and check out my Domino's versus Google IPO video. They both IPO'd the same year, some 15 years ago, and Domino's actually outperformed Google over those 15 years because you could have bought it at such a cheap discount when it IPO'd. So not paying too much for an outstanding company is extremely important. And we value that based on enterprise value to EBITDA metric, also cash flow yield, which we'll get there. Today, we're going to look at Amazon. I'm super excited to talk about it. It's an incredible growth story over the 20 years now that it's been out in public markets. It's absolutely crushing it. Is it still a buy? Let's find out. So all the numbers in here are fiscal year ending December 2019. It's now December of 2020. So there's almost a full year of material that's missing. So we're going to go to the Q3 Amazon earnings release, get a better gauge of what 2020 is going to look like. We'll put that in our model. All right, behind me is Amazon's Q3 earnings report. Let's take a look, get a smell check for what we think the number at the end of the year is going to come up with. Now, I want to hats off to the finance team here. The very first slide in this deck is free cash flow, TTM free cash flow, what we hunt for. The slide after that, cash flow less debt service. That's another one that we look for. And the last one is cash flow minus lease expenses, all of which, this one's showing 73% increase year over year. Free cash flow minus debt service is 26. Same thing with free cash flow TTM. So all of those are strong numbers. They're all focused on free cash flow, which I really, really dig. Thank you, Amazon, for doing this. And I want to give a note out to all of you watching the channel. I've made a lot of these decks for public companies and private companies. Believe me, if you do not have free cash flow, you lead with sales. If you don't have sales, you lead with customers. If you don't have customers, you lead with the tangible addressable market, the TAM. As a finance person, you're putting your best foot forward. These documents are sales documents like everything else. So you have to read it with that frame of mind. And the fact that these guys go right out of the gate with free cash flow, fantastic. I love to see it. So the first 3 slides, free cash flow, it's growing tremendous. Shares looks fairly flat, and they finally get to sales, which is growing. But let's just take this in mind. Sales growth, or excuse me, cash flow growth, somewhere in the 20 to 70% range. It's a monster range, but it gives us an indication of what they might do full year 2020. All right, now let's go back to the 10K. The first thing I want to bring out to your attention before we dive into the details is just what drives Amazon's cash flow. And that is going to be on slide 34. Here you can see behind me, and we'll put this up full screen, but Amazon Web Services right there in the 2019 year is $9.2 billion out of the $14.5 billion that Amazon as a whole generated. So that's roughly 60% of their operating income is coming from the AWS system. So as much as we talk about Whole Foods and how exciting that is, or the e-retail play and how online shopping is going up, all of that's great, but their cash flow is predominantly coming from AWS. Let's go take a look at the rest of the financials. We're going to come back to our sheets. Here we go. Let's take a look at 9 years of revenue data for Amazon and get a feel for what their revenue EBITDA is and then what the enterprise value looks like. So behind me right here is 9 years of revenue data. These are dollars in millions. So you started in 2011. Amazon produced $48 billion worth of revenue. That has grown to $280 billion. That's a lot of jack, man, every single year. Wow, that has grown 48, 61, 74, so on and so forth. Fantastic. If I kind of levelize that, that's a 25% annual growth rate to the revenue. An amazing number over a period of time. How do they keep that up? I don't know, but kudos for them. They're doing it. EBITDA, same thing. So $1.7 billion in 2011, growing to $36 billion last fiscal year of 19. That's amazing. From what I can see on the street and looking at the growth rate that we had showed you in the first 3 months of the year, they're trending on a $50+ billion EBITDA number for 2020. That is a monster number and a monster growth between prior fiscal year. But if I look at just the historical actuals that I have, that's a 46% annualized growth rate in EBITDA. So that means this number is higher than revenue. It means margins are growing as well as revenue. Fantastic. Great job, Amazon. Let's take a look at enterprise value and see what the value metrics are for the company. First number we're going to start off with is debt. What does the debt look like? It's relatively low. 1.5 billion growing to 77 billion. That growth rate is a lot, but don't forget earnings have grown tremendously as well, so I'm not too worried about that. Cash is huge here. $4.3 billion growing to 18 billion. When I read their recent quarterly report, they're saying they have $38 billion of hard cash sitting in the in the marketable securities line that's not really required to run the business. They haven't bought back shares with it. They haven't dividended it out. It's just piling up the balance sheet, and that's a lot of jack. Market cap is shares outstanding times price every fiscal year. There you go. It's roughly 10x from $83 billion to $885 billion. Whew. Monster growth. If I add up the debt, add up market cap, less the cash, I get an enterprise value. That is the value for Amazon. That is what, if you were to buy Amazon as an acquisition and you wanted to buy all of it debt-free, that's the price you would pay. We look at this number because ultimately the shares in the market are going to reflect the value of Amazon, and the value is the enterprise value. Quick note, the level of debt that a business holds on it, long-term debt and operating leases, that's a management decision. They can choose to pay cash for everything, or they can say, look, I'm not going to pay cash because I have a better use of the cash over here. I'll borrow and pay you, or I'll have an operating lease to get this piece of equipment. But it's a management decision. Ultimately, the value is enterprise value. And if they borrow against that, the market cap comes down, debt goes up, but the value of the company stays the same. That's why we look at enterprise value. Let's look at net debt to EBITDA. So this is our measure of bankruptcy. Remember, debt must be paid back, and the business will cycle up and down with economic activity, but that debt is a firm amount that needs to be paid, and we want to make sure that that is always low enough to never jeopardize the equity in the business, because ultimately, as equity holders, we are last in line in the bankruptcy court, and we're the first to be diluted if they issue more shares. So we want to be very cognizant of how much debt is on the books of the businesses we're buying. And here you can see net debt, meaning total debt less excess cash, divide by EBITDA. I have 1.6 times debt. That's less than 3 times. That's a great check the box for us. Let's look at enterprise value to EBITDA. Okay, what do we have? Here you've got a company that started at 47 times enterprise level to EBITDA. That's a payback period. It's 47 years of advanced earnings that you're paying for the business at a time. And that number has come all the way down to 26 times last fiscal. It's currently sitting around 30x, 31 times earnings. That's a long time. There's a premium to pay for a business. But I want to show you something here that's interesting. Had you bought this stock back in 2011 and you paid 47 times that year's earnings, which, if I get off to the side here so you can see it, was $1.7 billion. So they're generating 1.7. You bought the stock at that time at an $80 billion enterprise value. You paid 47 times earnings. Wow, that's a premium. Let's see what happened. Now we have hindsight. We can see what actually happened. So if I add these future earnings up, right, that's what they generated, and I get out to, say, 8 years, that is $75 billion. What was the enterprise value at the time you bought? 80. So that means you paid 47 times earnings in that year when you bought the stock. But the growth rate was so fast that they generated cumulative EBITDA over the next 8 years that equaled their market cap. So in reality, you only paid 8 times earnings in 2011 when you thought you were buying it at a much higher premium at 47. And that's due to the earnings, to the EBITDA growth rate that the company experienced. Okay, now that growth rate has come down as the business has grown. Investors saying, well, you can't grow that much faster or that bigger. How much am I willing to pay for it? They're saying 30 times right now. Okay, still seems like a premium, but let's go check on cash flow and see how much cash they make. We'll come back to this point in a little bit. So free cash flow from operations, right? That's the first third of the cash flow statement. When you look at it, let's take a look at Amazon and their cash flow statement so we can know that what we're looking at. That's at 47 right here. Operating cash flow, you can see it behind me. So when I say the first third, generally the cash flow statement is a full page, and you'll see this line here, proceeds, cash from operating activity. Right there, that is the operating line. That's the CFO. That's the first third, I call it. The mid third here is your investing capital. And then the final is your financing capital. So there's 3 sections to all cash flow statement. The first is how much cash do they make running their business? How much cash do they generate with Whole Foods, with AWS, with their retail business? That's here, right? Then this is what do they do with that cash? Well, they have to put some back in the business. That's that's purchases of property, plant, and equipment. That's their CapEx. That's what they need to put back in the business to make sure that the ball continues to run. All this other stuff is other acquisitions they make or just investing the cash that they have on the balance sheet. They have to do something with it. And finally, this backside, because they don't pay a dividend, they're not really buying back shares. It's piling up on the balance sheet, and you can see some of the little debt, some of the debt that they have that they borrow or pay back. It's very small, but it's there. That's the 3 statements of cash flow: operating, operating, investing, and financing. Let's go back to our statement. So what I've done is I've just laid out here the 9 years of the first third of cash flow statement, which is what we really want to focus on. That's what the cash they make from running their business. And it has gone from $3.9 billion to $38 billion a year. That's a 10-fold increase in 8 years. Fantastic. It's a 33% annualized growth rate, which dovetails nicely with the 46% annualized growth rate in EBITDA. So EBITDA is growing fast double-digit. Free cash flow from operations is growing fast double-digit. That is a great accounting check that the stuff that they report on their income statement is reflecting itself in pure cash on the cash flow statement. I got to match that. CapEx is growing in line, but they roughly keep it at about 40 to 50% every year of their free cash flow. So they're never in jeopardy of spending more CapEx than they produced in cash, which is a great sign. Debt here, debt's fairly small, right? Even though there was a big chunk here in terms of a down payment of debt in 2019, relatively, their debt at $77 billion over the enterprise value or the EBITDA is so low, it's really not an interest to me. I think they can more than easily afford it. So I'm moving on. Free cash flow to equity. This is the equity that is yours as an investor. And what percent of that equity is yours? Well, that's divided by the shares. You get your free cash flow per share. This is the number you're buying when you buy the shares. Forget the growth story for a second. Forget all the hoopla. They need to produce cash in order to have a value. This is the value they have. If they're not producing cash today, they better start producing cash in the future. If you're looking at some of the IPO stocks that are out there, you do something like this, it's a zero. You have to forecast the business forward, forecast the positive value of that cash flow, and then discount it back. That's your value. Here, it's already producing cash flow, so it's much easier to analyze. Share price at the end of the fiscal year, and I get a yield. In this case, the yield is really small, slightly above 1%. All right, but the cash flow is positive, strong free cash flow, looking good. Let's forecast and figure out what we want the business to look at. When we looked at the Q3 earnings, and when I look at what the street is showing, street estimates are $50 to $55 billion of 2020 EBITDA. I've picked here just shy of $52 billion at a 43% year-over-year growth rate. This is fairly certain. It might swing a little bit, but it's really, I mean, you've 3/4 of the year already booked. So I'm pretty certain in this one. Next year, 64 billion, I'm lowering the growth rate, right, from 43% to 25%. I'm less sure what's going to happen next year, it's going to be 2021, but B, most of the time analysts do bring down forecasts as they get bigger. It's just harder to grow that number. And what I can find out kind of in the street is that they're showing someplace of 180, 200 billion of EBITDA out 10 years. There's very few analysts that actually go out that far, but even 8 years out, they're still saying $180 billion of EBITDA. So I've taken the forecast and I'm stringing it down, lowering it over time to come up with a number that may or may not be realistic. That is a monster move. It's another plus threefold increase. So they did what we say 10x increase last decade or last 8 years. And the next decade, they're going to do 3x. It's not unreasonable if you think about it. I kind of feel like they can do that given the team, the track record. I think that might be completely doable. When I look at the enterprise value multiple, here is where we start to diverge between where we are in the street and where kind of current market and where I think we're going to be. As they grow and as this growth rate comes down, even the stocks that we have seen in this channel, right, they trade a lower multiple because growth is lower. If growth goes from 40% down to 9% annually, you would expect the enterprise value multiple that you pay to come down. I'm saying 20x. So that's basically saying that a decade ago or 8 years ago, they're at 47 times. They've come down to a low of 26. Now they're at 30, kind of bounced back a little bit. And I think over time, as they grow, that stabilized kind of fair value for Amazon that's growing at 9% out in these futures is 20 times. That says it's $3.4 trillion of value. I subtract some debt, add some cash based on historical ratios, I use the shares outstanding currently, and I come up with a price target. And that price target is $6,555. That's the 10-year out long-term forecast with a 20x multiple for enterprise value. Let's take a look at cash flow now. So cash flow is kind of the same story. I'm taking free cash flow from operations, less CapEx. I did not subtract that debt payment that you saw in 2019, because they have so little debt. I don't want that to cloud the numbers. They could have bought it. They could have paid it off. They could have not. The company would have been fine. So I took the sum of CFO and CapEx and divide by shares. I get 59, just shy of $60 of free cash flow. And I grew at the same rate that EBITDA would grow, and I get just shy of $200 of free cash flow every year. I then put a 3% yield on that. So that yield is higher than the 1.3% that they're yielding right now. That it reflects the premium coming down. Yields are inversely related to premiums. So as the premium comes down, the yield goes up. And I'm using a 3% yield. I get $6,499 as a 2029 price target for Amazon. Now we have two price targets. One that's an EBITDA market multiple approach. Another one's a free cash flow approach. We're going to average the two, and I'm going to get $6,527. I'll then drop that into an IRR forecast. So here we go. If you buy the stock this year, obviously there are 3 quarters that have already come through, but this is just an analogy. You can bump everything 3 quarters, it would stay the same. So buy the company now, $3,100, the rough price. I get this stream of cash flows that are either dividend to me, used to buy back shares, or used to go make other acquisitions that should grow the company even higher, kind of reinvested ROIC, if you will. This produces a net cash stream to me as an investor, and that discounted back on an IRR basis, that's a time-weighted investment internal rate of return, is a 12% annualized return. That is above market. It's not sky high because you are paying a premium right now at 31 times earnings, and that 31 times earnings is going to come down to 20. That's holding back the return. As an example, if I were to just focus on the EBITDA market multiple for a second, right? So it's just 12 times IRR. But now I said, let's take that market multiple, and instead of doing the 20 times, let's leave the 30x and see what it does to the valuation. 16%. So that is a 4% bump on an annualized basis. That means every single year you're earning an extra 4%, right? 16 versus 12. That's huge. That's the power of a multiple. And the problem is if you pay too much for it and that multiple comes down, it's going to weigh on your return despite of the success of the company may or may not have by hitting their forecast. So that's why it's very important. You don't pay too much for a great company, you try to pay a fair price. And I think anything in the sub 30s, ideally 25%, 26 like they were before, on a multiple basis is a fair price for Amazon. Let's take a look at the return distribution. I'm back now to the 50-50 split with the 20 multiple. And you can see behind me, you've got 3,100 roughly dollars a share at a 12% IRR. As that price goes up to above 4,000, you're in single digit territory. But if the shares come back down, say sub 3,000 a share, you're at healthy above market return. I like that. So I think I'm a buyer of this stock, but I'd love to see it a little cheaper. So if you haven't bought it, sit back and wait for it. It might turn if the market turns. We just hit an all-time high recently. I never like buying stuff when the stock is at all-time high. It fluctuates all the time. Put it on your radar, take a look, and if you see it below $3,000, definitely step in and buy it. That's at least my opinion based on this, the math exercise behind me. This has been a review of Amazon. I really hope that you liked it. Thank you for all the suggestions to do. Lots more stocks coming out. My name is Cameron Stewart, CFA. Talk to you later. Bye-bye.